This is the Fast Money Halftime Report. We don't follow the money, we are the money. Your Fast Money traders today: Joe Terranova from Virtus Investment Partners, Guy Adami from Drake & Capital, Peter Schiff from Euro Pacific Capital, and Gary Kaminsky, former managing director at Neuberger Berman. Right now, a 70-point turnaround pushing the Dow into barely the black for the year. Last night's fear that the Fed's discount rate hike would kill stocks now giving hope to the thought it may actually signal a stronger economy. Likely winners right now: financials and utilities. Joe, are you buying into this rally? You were up all night. You're looking good for being up all night trading oil.
And I'm absolutely exhausted. And yes, I'm buying into it. Of course I'm buying into it. I'm probably the lone bull on the desk, although I know Guy will admit the price action's phenomenal today. But this is the sweet spot right now for equities. What occurred with the discount rate being raised? They are not touching private sector borrowing costs. Those are going to remain in a low environment. What is it telling you by hiking the discount rate? That the financial system is flush again with liquidity, the capital markets are functioning, and the commercial banks themselves do not need to access.
I got to be the voice of skepticism here, because yesterday night on the desk when we were breaking down all this news, we were saying, you know what, this is the first step. This opens the door to a tightening of monetary policy sometime down the road, and that's what traders were reacting to yesterday night. Guy Adami today taking a look at the price action. Do you sort of take back or ratchet back that sort of assessment of the situation?
Hey, Mel. No,
hey.
No, I'm not going to ratchet it back, but Joe mentioned the price action, and you can't discount the price action. It's very strong today. You heard JC just now on his halftime, and he said basically talked to a lot of people last night that would tell you the market was going to be down 200 points today, and here we have it up 25, 30 in the Dow. So the price action is very strong, and you just can't turn a blind eye to that. That being said, I do think this is the beginning of a race, and it started last night. I think this will lead to tightening at some point, and I think at some point it's bearish, especially when you overlay what's going on in China, what's going on in Europe, and what's going on with another different things.
The market is not going up because the economy is strong. This quarter-point rate hike is too little too late. The market realizes that the Fed is behind the curve. The market is rallying because of inflation. People are buying stocks because they don't want to own cash. People are buying gold today because they don't want to own cash. This is not enough. Interest rates should be much, much higher. The fact that the Fed has got them at the discount rate at 75 basis points is a disgrace. This reckless monetary policy is undermining further the U.S. economy. It is very destructive.
Gary, I know you want to jump in here.
Melissa, we telegraphed last week that the end of easy money was here. It's very good that the Fed has started this process. I telegraphed that we needed to see the market be able to absorb higher interest rates, and that is a good sign. But for Joe to say that the capital markets are functioning, I don't see any deals being priced. I don't see any companies coming public. And M&A, while making somewhat of a rebound, is still slow. Capital markets are not functioning optimally yet.
Well, I take the other side of that. The credit markets, the spreads have remained narrow while we had this mild correction in the marketplace. If there are any fears about inflation, I believe we have a graphic. Look at the amount of capital that commercial banks are holding in reserve right now, north of $2 trillion. When that number begins to get lower, yes, then you begin to worry about inflation. But right now, there is no concern. There is no concern right now about inflation. The trade that's in front of you right now, the trade to make money off of, is reflation and buying the assets, the hard assets themselves.
I want to take a look at specific.
Investors who are not concerned about inflation are doing that at their own peril.
All right, Peter, on that note, let's get to your chart on gold, because you were a buyer before, you're a buyer now.
Well, look at the chart on gold. Gold doesn't only look good in terms of U.S. dollars. Look at the chart of gold in terms of euros, in terms of yen, in terms of British pounds. The fact that gold is doing so well against every fiat currency on the planet shows that inflation is a real concern. That's why people are buying gold. That's where the demand is coming from. People don't trust fiat currencies because governments are creating inflation. They want to own something that retains its purchasing power, and they want to own gold. And if you look at how well it's trading, even though we had a short-term bounce on the dollar, gold held up. Even though you had this rate hike, gold held up. I think gold is looking for an explosive move to the upside, and it could happen very soon.
And Mel, can I put some numbers on it real quick? You know, if you go back to American Barrick when they announced they finally purchased all their hedges back, I think that was December 2nd. That was basically the high of their stock price and was the high of the gold price, at least for the move that we had seen. We talked about it pulling back to 1,065, which was a level that we believe that India got in effectively when they bought some reserves, and we said that's where where you should get back into it. And in reality, that's exactly where it went down to. So I'm in Peter's camp a little bit in terms of the fact that it went down, tested a level we talked about, and is now rallying, but I'm not nearly as bullish as he is long term.
And Peter, if you are bullish, Peter, if you are bullish on the price of gold went up, are you also in the miners because they're much more leveraged to the upside?
I'm in a lot of miners. I own a lot of Barrick Gold personally. I have clients that own Barrick Gold as well as a number of other gold mining stocks, and I think that Barrick chart looks good. I agree that when they announced finally closing the hedge book, and it took them years to do it, that it did mark a short-term peak in the stock price, but it's not a long-term peak. If you look at that chart that you just had up there, I think it looks really good. I think before the end of the year, Barrick's going to make a new high, and maybe earlier in the year.
Just to put some context, that day, Guy Adami, you pointed that out, that very day, that they closed the hedge books, that was a 1,200. That was the high on
and
gold
and listen, Peter and I, we just speak in different time frames. It's not that we disagree. I mean, and he admits that the stock has pulled back. For our show, that was a significant pullback in terms of what Barrick did, though for a long-term investor, that might just be a bit of a hiccup.
All right, let's talk about oil today. And Joe, I know you're up all night trading oil, but oil is certainly holding in strong. Even when we saw the dollar rallying, right now we're seeing the dollars at the session lows, and which is perhaps why we're seeing stocks at pretty much session highs. What's behind this, though?
And I don't look like one of those young acne kids out there trading in the middle of the night.
Oh, you heard Steve Leeson talking this morning.
I heard Steve this morning, but what I will tell you about oil is this. There is an obvious concern in the marketplace about geopolitical concerns, about what is going to develop with the Iranian situation. Will it be sanctions? Will it be a strike on Israel? I don't believe that it is, but someone institutionally has been an aggressive buyer of oil over the last week. 3:30 in the morning last night, April crude oil gets down to 78 bucks. Big buyer comes in, sweeps up 2,000 contracts. That's the dead low for April crude oil. Never look back. There's buying interest. It's global. It's real interest.
I still think it's a currency phenomenon. I think people are buying oil because it's real and they want to get out of currencies. And I think that might have been the reason that the Fed did hike the discount rate 25 basis points. It was concerned about oil. It thought it could knock the price down with a small rate hike. And you know what? It's not working because oil's going up right in the Fed's face.
That's a good point. Before we move on here, Joe, just quickly in terms of the play off of oil, so the second derivative play here, that would be the agriculture stocks.
Yeah, the ag names are the one name when you look at and you talk about hard assets as a high correlation. Ag names to energy prices around 0.8 as oil prices rise. The ag names go with it. Ag names really haven't performed well so far this year, but I believe names like Potash and Mosaic, you can play those betting on higher oil prices themselves.
Okay. They actually have performed very well. Look at some of the names out in Asia, in Hong Kong, in Singapore. These ag stocks in Norway have done really well. I own Potash myself. I own it for clients. I think it's a great way to play inflation because agriculture prices are very, very they move quickly when you have inflation.